You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Last week, we looked at the battle of cash-secured puts versus selling a call on a position that you owned. Now, overall, I kind of like the concept of selling a cash-secured put, and if you had some money that's just laying on the sidelines and you're trying to at least earn a decent percentage on that money, we determined that the cash secured put would probably be a better idea than selling calls on positions, specifically on positions that you're way down on. And the biggest reason why I believed in that is that I just don't want to get caught in a covered call position, fixating yourself on a loss on that stock. In other words, in my opinion, the volatility was there to sell either calls or sell puts, but the vol of the market coming back and not being able to get out of a call position or whatever and getting pegged on that stock, I think the risk was a little bit higher. So I like the concept of selling a cash secured put to buy a stock that I may want to participate in at a later date, as opposed to selling calls on positions that I already had. Now, we're going to keep with that same type of theme right now. And I'm calling this overall at Ally. We actually had our first digital conference. And in the title, we used the acronym FOMO, which stands for fear of missing out. So a lot of people probably today are kicking themselves saying, gosh, why didn't I buy that airline, or why didn't I buy that retail stock? Because all of them started to come back a little bit, especially some of the staples. Walmart has done well. Home Depot had a good run recently. We had even some of the oil companies. ExxonMobil had a good run today, but the stocks are still extremely volatile. So what do we do in this scenario? You're not necessarily going to pick the bottom, but then again, when do you jump in? How can I protect myself? What can I do? Oh my gosh. All right. Well, here's what we're going to focus on today. I'm going to look at a strategy that we actually mentioned on Options Playbook Radio going into the new year, where if you had some big gains on some stocks, maybe now was the time to sell the stocks and buy deep in the money leaps as a surrogate for the stock, basically 80 delta leaps that would go out a certain period in time. And I'm sure that Options Playbook Radio probably fell on some deaf ears back in that point in time, mainly because why should we be worried about it? There's no risk in the marketplace. It just goes straight up. Why should I be concerned with this scenario? What is Brian talking about? Give me a Give me a spread that I can trade next week on earnings, that type of concept. Well, on Options Playbook Radio, this is never meant to be a recommendation, and I don't necessarily know what stocks you're looking at. But today, I just decided to choose Microsoft. Microsoft right now, a lot of things out there that Microsoft does. One of the things is that they do own Skype, and Skype actually has been used a lot for a lot of the people that are stay at home. So there's just a lot of different products, not to mention just the fact that they're in computers right now, and a lot of the firms have to be buying additional computers so that people can work at home, additional memory, all host of things that Microsoft actually plays in. And in general, the NASDAQ overall has not been hit quite as hard as the S&P 500 index, but specifically definitely has not been hit as hard as the Russell or the small cap index. So maybe I want to participate in Microsoft. Microsoft has been down right now it's down about 20% from its highs. When the downturn started, the stock was at 190. Right now I'm showing, and I should mention this, we're taping Options Playbook Radio. It's the 25th. Markets are closed right now, and Microsoft closed today at 146.92, down $1.42 on the day. That puts, I'm just going to round off here, but that puts Microsoft down about $43 since the big downturn. Okay, so I'm going to pretend that this is one of the stocks that we might want to try to buy at a lower price. How are we going to approach this, and what might we do to approach this position? Okay, so the stock at one point in time now is down, like I said, approximately 20%. I don't want to lose more than 20% on any one position, and that's going to be the theme here. When I mentioned this strategy before the big downturn, that was one of the things is you looked at it and you say, well, at that point in time, you could buy like 80 Delta Leaps going out a decent amount of time and, only put up 15% of the stock price or so and get a decent delta on it. Well, that's not the case anymore because the market has changed overall. The volatility index is right around 60. We're seeing just in general, I think the minimum implied volatility on any of the FANG stocks is probably 70 or 80% implied volatility. And we're not even into earnings yet. And that's another point that we got to start talking about. We got to start thinking about earnings. Like today, Micron Technologies, they went out and they announced earnings after the close today. Right now, that stock is up actually quite a bit after announcing earnings. But we're going to be getting into more volatility as earnings season hits. Okay, so what is going to be the paper trade for today? And I'm saying you can take this concept and apply it to any stock that you may be thinking about. You may say to yourself, well, 22% of the stock price, that's a lot as far as options are concerned. But heck, back in December, if you would have did this or take this approach, you would only be down a minimum of about half on most of your positions if you had substituted long-term leap options as a surrogate for ownership in the stock. Okay, so with that said, let's talk about Microsoft. I'm looking at Microsoft right now. I'm going all the way out to the July expiration. Right now, that's 114 days out. In other words, we're going to get ourselves in the summer. We're going to go deep into money, and I literally just went down until I saw an 80 Delta. And the 80 Delta option contract is trading at 120. The market's fairly wide, but the markets are closed right now. But the midpoint is all that we're going to work off. No guarantee of a midpoint fill, especially in this day and age. But at the midpoint, with the markets closed, that option contract is trading for 32.35. So based off of a 146 close, you're putting up about 22% of the stock price. And what does this mean? Overall, this means that we cannot lose more than that 22%. Now, that still sounds massive, but overall, considering what some people have lost in the marketplace, that's not a bad alternative. And in order for us to lose all that, basically the stock has to be below 120 by that July expiration date, 114 days away. So we have a lot of intrinsic value. We have a lot of real value in this. So that gets to my point of time value. We have to pay up for these option contracts right now because of the scenario that we are in as far as implied volatility. And so because implied volatilities are so high, that leap option contract, well, in general, that leap option contract has $5, and I did the math, $5.43 worth of time premium in it. And that's fairly important to me. I got to realize that is time value. That's not real value. And that's the downside of buying the option as a surrogate for owning the stock. We're going to get a lot of stock representation. The delta is 80 cents, which means that if the stock goes up 1, our option contract should go up by approximately 80 cents. Might go a little more or so. The delta is dynamic, but if it goes up 1, we would gain by 80 cents. If it went down 1, we'd lose by 80 cents. That's the concept in theory of delta. So a lot of times when you think of delta, a lot of people reference it as the percentage of stock price movement. If I owned 100 shares of stock and the stock went up 1, I would make $100. If I own this option contract, which represents 100 shares, and the stock goes up 1, I get 80% of that movement. And that's a different way to look at delta, and I prefer to look at it that way when I'm talking about buying leaps as a surrogate for the stock. What percentage of that movement do I get? And here I would get about 80% of that movement. All right. So last week, and I mentioned this when we started this call, that we talked a little bit about selling calls on positions that you own versus selling a cash secured put on a new stock that you might want to buy or to add to your position that you already have. And in that scenario, I was talking about the cash secured put being a little bit more of interest to you. Now, in Microsoft, if I did this trade, and I just want to point this out, you can do something that is actually called the fig leaf. And I've talked about the fig leaf on the show, and we've made that the paper trade inside Options Playbook Radio. We've done that more than once where we've talked about a fig leaf. But this would be a scenario that you could do that. I'm a little bit worried about the snapback, and I definitely don't want to be selling calls going into earnings season. So I want to be very aware of when the company is going to be announcing earnings for 2 reasons. One of the things, just in general, I don't want to have to be dealing with trying to close out a position if the earnings are good, and also you're capping your upside, but you still have all the downside risk if the earnings is bad. The call kind of helps out. All right. So with that said, I digress a little bit. Let's look at what we could do with Microsoft. Microsoft right now is anticipated to have earnings the week of April 22nd. It's not set in stone yet. So we're going to say the week of April 22nd. So we want to make sure that we're looking at an expiration before that. And lo and behold, the April 17th expiration is the normal monthly expiration, which is a preferred as far as expirations are concerned. I'd rather be in the normal monthly just because markets are a little bit wide in general when markets get volatile. So if I could stay in the monthlies, you get a little bit more volume, usually a little bit more open interest, means you have a little bit tighter markets. So for example, with the stock at 146.92 right now, I could go out 23 days and I could actually sell something that would have close to the same amount of time premium as I'm buying. And this would be an alternative. If you're really worried about that time frame, which it's a lot of vol, it's a lot of time. So overall, that is a fairly big chunk of that $32.35 that we'd be paying if we bought that leap option contract. I could sell the 155 strike call right now. Now, the market is wide on it because it's closed. It says 450 by 605. Let's just say we could get that 540 for it, right at the midpoint for it. Then on our position, we're talking about being, if I go from 147 to 155, you're still 8 points out of the money. You got 23 days until expiration. You're not even into earnings. You're getting 60% implied volatility on that option contract that you're selling, and you're taking that time component out of the picture. So this is an alternative. I personally would probably not sell the 155. I would look at going a little bit higher, giving myself a little bit more opportunity on the upside. And for example, I could go all the way up to the 170. And right now I'm still showing that at the midpoint is trading for $1.40. The 160 is trading at the midpoint for about $3.50. So you can even give yourself more upside if you'd like. You won't quite get all the time premium in one chunk, but you're going to get a decent amount of it. And I just want to make sure that if I'm doing this trade, I'm probably not going to be short a call option on my leap position going into earnings. All right, so that was a lot said. Now, remember, this isn't just Microsoft. It's whatever underlying you may think about buying, and you have a fear of missing out. Maybe instead of buying my 100 shares of Microsoft and spending $14,600, I go out and I buy one call to just dip my toe in the water, right? To just get my feet wet in case this is a true V-shaped recovery. And the fact that the market skyrocketed up today, it could continue going into the summer months right now. So this gives you that opportunity. And on top of it, so you have that position, if July comes, you can actually just exercise that call. Buy that stock at 120. Make that your cost basis on your underlying stock where you would be buying it at. That's a viable opportunity. Then that gives you that chance to be long that Microsoft for as long as you'd want to hold on to that position. Now, I like talking about this strategy in a down market right now because more people are listening. How can I participate in this marketplace without all the risk of just owning the stock outright? And as I said, if you go all the way back to December, we talked about this strategy, but I guarantee this particular Options Playbook Radio will probably get more quote-unquote listens than the one in December, mainly because of where the market is at this point in time. So let's recap the trade and we'll call it a day. We're going to look at a FOMO trade, fear of missing out in Microsoft. I'm thinking about buying 100 shares of Microsoft, or I might be thinking about buying 300. Let's make that the scenario. I'm thinking about buying 300 shares. I don't know what time to get in. I'm going to dip my toe in the water. I'm going to go a little deep into money. I'm going to go out to the July expiration, 114 days out, and I'm going to buy the 120 strike. Right now, the midpoint of that is 32.35. Hopefully, we could get a midpoint fill on it, but the markets are a little bit wide. And with that, we have $5.43 worth of time premium in that. If we did fill at 32.35, that would be our maximum loss. So if we bought one contract, $3,235 plus commission would be our maximum that we could lose on that trade. And we would have the right to buy Microsoft at 120 anytime before that July expiration, 114 days away. Then you can consider selling a little bit of time premium against it. We talked about the normal monthly expiration April 17th, about 23 days away. There's some massive premium that you can get on that position. And I don't mind selling calls on new positions right now. This strategy, if you did buy the leap and sell the call inside the Options Playbook, we call that the fig leaf strategy. And I don't mind it on a new position. I just don't want to peg myself on an old position that has gotten beaten up in the recent market downturn. All right. Well, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.li.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out. Stay safe out there.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.